When people actually drive electrified vehicles, they really like them. And of course, right now, from a cost standpoint, with gas prices being low, it may not be as compelling, but they really like it. And then the second consideration, as you mentioned, is the regulatory requirements that we have to meet. So both of those are driving this investment. But importantly, it's around building on our electrified leadership, because we're the second largest seller of electrified vehicles in the U.S., and we're the leading provider and seller of plug-in hybrids in the country.
You've been leaders as well in the kind of technology mobility front. You've opened a big office in Silicon Valley. You've been experimenting around the world with different forms of mobility. And now you've got this dynamic shuttle service. Right now it's an experiment, but it looks to me like you're trying to take on Uber head on. Is that the case?
Well, we're really looking at our business these days as our core business, which is designing, developing, and manufacturing and marketing terrific cars, utilities, and trucks. And these emerging opportunities, which we're managing under what we call our Ford Smart Mobility Plan. And these days, when you look at customer requirements, particularly in urban areas and particularly for young people, a lot of them want access versus ownership. And as a company, we're looking at this holistically and saying, how can we satisfy customers by getting around? And a lot of that comes back to thinking like a mobility company and an auto company.
You've said 2020, by the time fully autonomous vehicles will be on the road. And Travis Kalanick at Uber has said someday they won't need drivers. Now, he's got a $60 billion market cap and an algorithm. You have a $50 billion market cap and the cars. I mean, don't you win that battle?
Well, I think first off, it comes down to, we're a manufacturer and marketer of great cars, utilities, and trucks. When you have the foundation we have in terms of being able to be very good in this core business, it opens us a lot of opportunity for us going forward. So, yes, there's the Ubers, there's the Lyfts, there's a whole host of those kind of companies out. But as thinking like a mobility company and really getting back to how to make people's lives better, it's really spurring us on to do a lot of innovation in the company and look for ways to satisfy customers and, as I mentioned, create a good business opportunity for us.
The industry, it's on fire right now. It doesn't show any signs of abating. Your finance unit is doing great, and yet the shares are down for the year. Why isn't Wall Street valuing this company the way a layman would see it from the outside, the way I see it from the outside?
We think we're focusing on those things that drive value in the valuation of the company, which is really around growing our revenues, expanding our operating margins, and making sure that we have a healthy dividend. We're not running the business just to juice the stock price. We're running the business to run a healthy, growing enterprise, and over time, I think we'll get recognized for that.
You have been able to lift the dividend to reward loyal shareholders. Do you see more of that going forward? I mean, are you expecting to do that again in this coming year?
Earlier this year, we raised our dividend, and our approach is to make sure that we have a dividend that's sustainable through the economic and business cycle.
You've spent time with Janet Yellen. You've met with Federal Reserve governors. What's the sense that you get as far as how we're going to see the lift coming on in 2016?
I think we have to put it into perspective. An interest rate rise is really an indicator of a very healthy economy. That's good news for the auto business. But we expect going forward that the rates will rise gradually, and we don't see a huge impact. And when you look at the auto industry and you look at the age of the vehicles out there, and then you combine that with the state of the labor market, wage and income growth, we think that's a great recipe for continuing to support healthy industry-level sales over the next couple of years.
People keep talking about subprime auto loans. We know that terms are getting longer. Is there any concern for you or for Ford Motor Credit if interest rates rise that will be affected?
Well, I think we've been very prudent, particularly around the terms of our loans. We've seen overall in the industry terms extend over time, which is a bit of a concern for the industry. And we've been at a very tight range in terms of offering credit in the subprime area. So I think our team has managed it very well, and I think that will serve us well going forward in an era where interest rates will rise.
I can't wait to get behind the wheel of a GT350 Mustang with a 5.2-liter V8. Is the V8, though, destined for the museum? I mean, is it going the way of the V12 with the EcoBoost twin-charge V6 engine coming along?
There's still a lot of demand for that kind of engine. It's iconic. It's interesting, when you look at our Mustang sales around the world, we expected in places like Europe, they would more prefer maybe our 2.3-liter EcoBoost engine. But in actuality, a majority of the orders are the V8s. They want that iconic 5-liter V8 engine. So I'll never say never going forward, but we think it has quite a life left to it.